In this video, we're going to talk about managing your money. Essentially, what we're going to do is we're going to talk about different types of financial instruments, investments that you can make that will provide liquidity. And in the end, we're going to talk about how this ultimately fits into your financial plan. So let's start. Money management talks about those decisions that have a short-term impact on your investments. Short-term cash inflows and outflows. Liquidity refers to your ability to cover any cash expenses and or deficiencies that you might have. So this obviously relates to your personal cash flow statement. In the end, liquidity ultimately has an impact on your net worth. So should you use credit cards for liquidity? Credit cards are an essential part of life. You probably should have one. Doesn't mean you need to use one. So the interest rates on most credit cards are pretty high. Unless you have a very, very good credit rating, you can expect to pay 18 to 19% on basic credit cards from a bank. If you're getting credit cards from a retail company, right? If you have a Lowe's card or a Sears card, you can expect to pay anywhere from 25 to maybe 29% on that interest. So the interest rates can be very high on credit cards. It can help you when times are tough, but again, it has such a high finance charge, it probably isn't the best tool to rely on totally. So we want to be able to get some kind of a return as well, right? So liquidity refers to not just using money, borrowing money, it also refers to investing money. You want to be able to get a high rate of return or as high as possible, and you want to be able to get your money quickly. So what are the money market investments? Those investments that by definition are liquid or very close to being very liquid. Checking accounts are very liquid. Not really an investment. Most don't pay an interest. If you do get an interest, it's very low. But they're not technically a money market instrument. They're not what you would refer to as essentially a security of any sort. A NOW account is what's referred to as a negotiable order of withdrawal. It's a type of deposit that provides checking services and is paid to interest. So now this is not strictly a checking account, but it has an interest rate that now moves it to more of an investment. The challenge with these NOW accounts, interest rate is very low, they're very liquid. Some of these require a minimum balance though. If they require a minimum balance, that reduces liquidity. It reduces the amount of money available should you need it for some type of an emergency. Certificates of deposit. Essentially what we're talking about here are referred to as retail CDs. These are the things that you get at your bank, right? They typically have small denominations. They pay higher interest rates typically than savings deposits, but again, not very high. Now, what people will say also is that liquidity is an issue because they have penalties imposed for early withdrawal. And typically, it's 2 to 6 months of interest. Again, you can have a choice between a number of CDs. We had mentioned bankrate.com, where you can go out to a bank, to this site, and find CDs across the country. You can go to any banking website and see what their current CD rates are. But let's talk about this penalty. If you have a $5,000 CD and it's in a $5,000 in a 4-year CD paying 3%, and you decide to take your money out early, what's the penalty if it were a 6-month penalty on early withdrawal? Well, 3% of $5,000 is $150 per year. If you divide that by 2, roughly you get 6 months of interest. Roughly it'll cost you $75 out of the $5,000 in order to withdraw your money early. So is there a penalty? Yes, but because interest rates are so low, the penalty, quite frankly, is relatively small. And in fact, if it was a 2-month CD, right, instead of dividing the 150 per year by 2, you divide it by 6, right? Now we're talking in the ballpark of around maybe $30 would be the penalty. So again, there is a penalty, but the penalty typically, because of low interest rates, is not a substantial dollar amount. A money market deposit account, the bank itself creates these accounts. Essentially, they invest in money market types of investments. They invest, we'll talk about those in a couple of minutes, but they're a little bit less liquid than checking. They pay higher interest rates, right? So a lot of people will have a checking account or a now account for day to day. And then if they have longer term efficiency or emergency needs, they might have a money market account. One of the things I find is that most people get confused fairly quickly with where their money is if you get too many accounts. So it would be nice if you could figure out a combination, checking account and another account for rainy day funds. Getting too many accounts might be a little confusing and overwhelming, especially as we get a little bit older in life. So if you think about money market accounts, what are the kinds of securities that are in there? There are 2 primary securities. One is called a treasury security issued by the United States government. By definition, they are treasury bills. They have a maturity of 1 year or less. When you buy one of these treasury bills, you purchase it at a discount. So if it's a $10,000 treasury bill, you may only pay $9,500 for that treasury bill. If it matures in 9 months, when it matures in 9 months, you get the $10,000. So you paid $9,500, you get $10,000. That $5,000 increase is going to be considered either a capital gain or interest. Most of the time, interest. So that's the return that you get on the T-bill. You can buy and sell these in the secondary market. You can find prices online and in financial news publications. So they're obviously, since it's the United States government, they're very popular and they are plentiful. Commercial paper is a short-term debt security that's issued by large corporations. They have a slightly higher return than treasury bills because it is possible that corporations could default. But most of these are very large corporations, have been around for a very long time. They have really good financial standing. So most of the time, they're also considered to be relatively low risk. So essentially, a money market mutual fund includes these 2 kinds of securities, mostly treasury bills, but there are some others that are a little bit less popular, if you will. We also have money market mutual funds. Again, this is an account. It's a pool of money from individuals. The money market account, the money market mutual fund or the mutual fund account, invest these in short-term maturity. Again, assets are typically invested in are 90 days or less, mostly treasury bills. Here's an example of the STAR fund. The average maturity in the fund's about 43 days. In this case, the 7-day yield is 3.28%. And they have about $496 million in this particular money market account. So again, this is just another place to put your money. It's essentially a mutual fund of sorts. My personal opinion is if you should have a checking account and you should have a money market account, a money market mutual fund account. Many of these money market mutual fund accounts will actually provide you with a checkbook. Now, you can't write your monthly bills from there, but you have a checkbook that if you need cash, you can write a check and it's just withdrawn from this money market account just like it was a checking account. So you get a higher rate of return than some of the other investments that you have because it's managed more by a mutual fund company. But you also have the convenience of a checking account. An asset management account is more of a brokerage account that combines deposit things with this brokerage account. They have an example of this they refer to as a sweep account. So at the end of every day, if there's any extra money in your brokerage account, it moves that into this money market investment at the end of each day. And of course, it can move money back. If you need it during the day, the money moves back. So again, an asset management account, it's just a special kind of account that is a combination of deposit kind of accounts like a checking account with a brokerage account. You get one statement, money moves freely between the two. And we have a table that basically shows us the advantages and disadvantages of these. Again, I'd like to go down to the bottom here just that money market mutual funds are liquid. They're not as liquid as checking, right? However, they could be. If you have a checkbook, they are exactly like a checking account. So they have higher rates of returns. They are liquid. Money market accounts and checking accounts are the only kinds of accounts that I think the average person should probably have an interest in. I'll talk to you in the next video.